Hi. Let's learn about cost of goods sold, COGS. Cost of goods sold refers to the direct costs of producing the goods sold by a company. This amount includes the cost of the materials and labor directly used to create the good. It excludes indirect expenses, such as distribution costs and sales force costs. COGS is also referred to as cost of sales. COGS is an important metric on financial statements as it is subtracted from a company's revenues to determine its gross profit. Gross profit is a profitability measure that evaluates how efficient a company is in managing its labor and supplies in the production process. Knowing the cost of goods sold helps analysts, investors, and managers estimate a company's bottom line. If COGS increases, net income will decrease, which is beneficial for income tax purposes, but results in less profit for shareholders. COGS includes the direct cost of producing goods or services that were purchased by customers during the year. The formula for calculating COGS is, COGS equals beginning inventory plus purchases during the period, ending inventory. Inventory that is sold appears in the income statement under the COGS account. The beginning inventory for the year is the inventory left over from the previous year. Any additional productions or purchases made by a manufacturing or retail company are added to the beginning inventory. At the end of the year, the products that were not sold are subtracted from the sum of beginning inventory and additional purchases. The final number derived from the calculation is the cost of goods sold for the year. The value of the cost of goods sold depends on the inventory costing method adopted by a company. There are three methods: first in, first out, last in, first out, LIFO, and the average cost method. The special identification method is used for high-ticket or unique items. FIFO sells the earliest goods first, LIFO sells the latest goods first, and the average cost method uses the average price of all the goods in stock. The special identification method uses the specific cost of each unit of merchandise to calculate the ending inventory and COGS. Many service companies do not have any cost of goods sold at all. Additionally, the IRS website lists some examples of personal service businesses such as doctors, lawyers, carpenters, and painters that do not calculate COGS on their income statements. Examples of pure service companies include accounting firms, law offices, real estate appraisers, business consultants, and professional dancers. Costs of revenue exist for ongoing contract services that can include raw materials, direct labor, shipping costs, and commissions paid to sales employees, but these items cannot be claimed as COGS without a physically produced product to sell. Many service-based companies have some products to sell, such as gifts, food, beverages, and other items, and therefore can list COGS on their income statements and claim them for tax purposes. Both operating expenses and cost of goods sold are expenditures that companies incur with running their business. Unlike COGS, operating expenses are expenditures not directly tied to the production of goods or services, and include overhead costs that are not directly tied to a product. COGS can be manipulated by accountants or managers looking to manipulate financial statements. It is important for investors to spot unscrupulous inventory accounting by checking for inventory buildup and examining changes in COGS over time. High COGS places downward pressure on a company's gross profit, so companies sometimes choose accounting methods that will produce a lower COGS figure, attempting to boost profitability. COGS is calculated by adding up the various direct costs required to generate a company's revenues. COGS is based only on the costs that are directly related to the production of goods. COGS does not include salaries and other general and administrative expenses. However, certain types of labor costs can be included in COGS, provided that they can be directly associated with specific sales. For example, a company that uses contractors to generate revenues might pay those contractors a commission based on the price charged to the customer, and that commission might be included in the company's COGS. In theory, COGS should include the cost of all inventory that was sold during the accounting period. In practice, however, companies often use accounting methods such as the first in, first out and last in, first out, LIFO, rules to estimate the value of inventory sold. This can affect the company's reported profitability and gross profit margin. Here are 4 key takeaways. 1. COGS is deducted from revenues in order to calculate gross profit and gross margin. 2. COGS differs from operating expenses in that OPEX includes expenditures not directly tied to the production of goods or services. 3. COGS can be manipulated by accountants or managers looking to deceive shareholders. It is important for investors to spot unscrupulous inventory accounting to accurately assess a company's financial health. 4. High COGS places downward pressure on a company's gross profit, so companies may choose accounting methods that produce a lower COGS figure in an attempt to boost reported profitability. Hope this would help. Thanks for watching.